Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Well, Israel said 8 of its soldiers were killed in clashes with Hezbollah in southern Lebanon. First casualties it suffered in an expanding ground incursion amid fears of a spiraling conflict with Iran. Meantime, Benjamin Netanyahu vowed to retaliate against Iran after it fired about 200 ballistic missiles at Israel, a major escalation that world powers fear could spiral into a Middle East-wide war, or, as some of the conversations we had yesterday, Tim, a World War III.
It's not just that. Televised comments made during a visit to Doha. Iran's president said if Israel takes further action against Iran, the Islamic Republic will, quote, give stronger response. And President Biden says G7 nations are discussing sanctions against Iran in response to the latest attack against Israel.
All right, so let's get to it. Let's get more with retired Lieutenant General Michael Groen. He is Geopolitical Intelligence Group Member and Advisory Board Member at Academy Securities, joining us from Virginia. General Groen, great to have you here with Tim and myself on Business Week. Are we likely to see more back and forth between Israel and Iran for some time?
Yeah, inevitably. I think we've been on this cycle since October 7 last year, and I think where we look at the who has the balance of escalation, who can escalate this, and it seems like every time that the Israelis achieve an objective that they've established, the Iranians or their proxies will escalate once again, and they'll pull another trigger. And so, we're in this do loop of continuous trigger and response. Of course, now it's really become serious when we start talking about an Israeli ground invasion. And again, as you just said, 8 Israeli soldiers already killed in the action. Once you're on the ground, especially in the broken terrain of southern Lebanon, it becomes extraordinarily dangerous and extraordinarily difficult.
I do wonder, one of our concerns, Bloomberg Opinion writing about it, or Andreas Kluth, about, when does what Israel is doing become offensive versus defensive? And should then the U.S. and other global allies rethink its support of Israel?
So thanks for the question. It's a very complex situation, of course. The state of Israel, has suffered hundreds of rockets a day, for many weeks here as Hezbollah has made the northern part of the country uninhabitable. So, even from a humanity aspect and from a law of armed conflict aspect, Israel has a right to defend themselves beyond their borders in this space. That said, this is not the first time that there's been an incursion into southern Lebanon, and in fact, you think about going back years ago, even 1983 when the U.S. Marine barracks was bombed in Beirut. There has been a long history of tit for tat across that border. The Israelis and the UN have articulated the Litani River as the border. That's about 20 miles north of the current border of Israel. And that's 20 miles of really rough terrain, really dangerous terrain, and really difficult terrain to operate on.
I want to go back to this idea of seeing an end to this conflict. And I'm wondering, given that there is this tit for tat, this idea of retaliation, after one side makes one move and then the other side retaliates, how do you see this conflict ending, at least this iteration of the conflict?
So this iteration of the conflict, I think the principal parties are of a hard stance here. President Netanyahu, or Prime Minister Netanyahu, of course, has talked about what he's willing to do and what he wants to do to achieve the safety of Israel, and there's not a lot of wavering on the Israeli side. On the Hezbollah side, or on the Iranian side, even with the loss of many of their Hezbollah commanders and their IRGC commanders, we should always remember that those commanders are on the ground with Hezbollah in Lebanon. Even with a really not very effective sortie of missiles against Israel the other day, the Iranians are still calling for retaliation. So they are stuck on a wheel here maybe the only thing that can start to bring at least a place to talk outside of tit-for-tat exchanges, is a relationship with other countries in the region. And here I'm talking about Jordan and Saudi Arabia and the Emirates, Egypt. Like, is there a way to get back to the table, at least stop firing missiles while we're trying to figure out what a long-term solution looks like?
Is a long-term solution, does that include a two-state scenario in the end? And just got about 30 seconds left here.
Well, clearly, Lebanon is a captive state. It's been captured by Iran, and so and then if you look over to Gaza, kind of when we talk about a two-state solution, there's even the Egyptians don't want to govern Gaza. It is in its current state, it is completely ungovernable. Until Sinwar goes, and he's not going to go, with his boots on. So, like, it is until we get some resolution, where this tit for tat is going to continue.
All right.
There's not an off ramp.
All right, got it. Thank you so much, and so glad we could reconnect with you. Retired Lieutenant General Michael Groen, Geopolitical Intelligence Group Member and Advisory Board Member at Academy Securities.
This is Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, you are listening and watching Bloomberg Businessweek. Carol Massar along with Tim Stenovec, a lot going on. We do want to mention a headline that crossed: Microsoft investing about $750 million in OpenAI's latest fundraise, if you will, or fundraising round, which is I got to just say, this raise just has kind of blown me away. How much?
Yeah, Microsoft has already invested $13 billion in the startup. NVIDIA, another name in there. Listen to this, Carol. OpenAI completed a deal to raise $6.6 billion in new funding. That new valuation at $157 billion.
That's quite a fundraise, if you will.
Yeah, the question is, where does it go from here?
Yeah, it
costs a lot of money to run this company. Every time you look something up on ChatGPT, that costs money, uses a lot of energy.
We talked about this with our Max Shafkin, right? The idea that it costs a lot of money to run it. So they're still trying to figure out, I guess, the way to profitability. It is, by the way, the deal, one of the largest ever private investments, makes OpenAI one of the three largest venture-backed startups alongside Elon Musk's SpaceX and TikTok owner ByteDance. That's according to people familiar with the matter who asked not to be identified.
Other names: Thrive Capital, Khosla Ventures, Altimeter Capital, Fidelity Management and Research, SoftBank, and the Abu Dhabi-based tech investment firm MGX also participated. I
think what's also staggering is that it's been a turbulent year for OpenAI, to say the least. So it's interesting to see this amount of money coming in to the company. I got to say, AI is certainly one of the trends that we've been all over for the last year and a half, and so is the new diet drugs that are out there.
Yeah, because Ozempic, well, we're not scared anymore. That's what food industry executives seem to be saying right now after initial concerns about what Ozempic and other GLP-1s, Carol, would do for their products. If people were taking these drugs, are they still going to buy as much food as they were buying before?
Well, it turns out big food, they're kind of warming up to the GLP-1 drugs. Let's get to it with Bloomberg News consumer reporter Deena Shanker. She's with us in New York City. Great read. Deena, just remind us, first up, that initial terror, we used to talk about it, right? These new drugs were out there and all the food companies, the packaged food companies were like, oh my God, what's going to happen to all our businesses? Remind us about that backdrop before we get to where we are today.
Sure. So I can tell you, for me, it started last fall when I was interviewing Steve Cahillane, the CEO of Kellanova, the snack company. And I asked him, well, what are you thinking about these GLP-1 drugs? And they were like, listen, we're watching it. We're not sitting here. We're not being, just complacent on this, but we're watching it, and we're prepared to mitigate any impacts. We then saw less than a year ago, earlier this year, that the CEO of Novo Nordisk, which makes Ozempic and Wegovy, that they told us that they were getting phone calls from CEOs of food companies that were scared. They didn't know what was going on. And there was this big question that was coming up. We saw it in news headlines. It was just like a major topic of conversation. Was Ozempic going to finally deal a blow to big food that any diet trend of the past was simply unable to do?
And just in case anybody forgot, Kellanova makes those good things like Cheez-Its and Pop-Tarts and all those good things.
Pringles.
Exactly, right? Some really
Things that
good
maybe
stuff.
you wouldn't eat as much of if you're taking Ozempic.
Perhaps.
But Deena, you're also here to tell us that big food, well, they're going to be just fine. How have they adapted?
Well, so that's what they're saying anyway. What we found is that some companies are basically like, oh, well, we're like, our portfolio is perfect for GLP-1 users.
Of course.
So we saw Nestle roll out an entire new line called Vital Pursuit of basically like frozen single serve meals that are high protein. They have fiber. They have the nutrients that people are looking for when they're on these drugs, or often when they're not on these drugs. And so then we also heard other companies like Campbell Soup and Danone say in public presentations that they had foods that were perfect for this cohort. And we spoke with ConAgra, which has spoken a little bit about this before publicly, and we had a conversation with them asking them what they've seen. And they said they're seeing it. They're seeing a bump in their frozen single-serve meals. And it's small, but measurable. And it's certainly something that they're going to keep an eye out to see how it changes.
All right, so what does the investment community say about all of this? They're like, great, new revenue stream, or they're like, wait, the jury is still out on this?
So most of the people that I've spoken to, most of the analysts, experts, et cetera, were like, yeah, there's opportunity here for some of these companies. And one stressed this, his name is Bobby Gibbs. He's a partner at Oliver Wyman. And he was stressing just that, like, even if you're not on a GLP-1 drug, maybe you were and you got off, or maybe you never were, but you really are just health conscious. This is a growing part of the world of American consumers that we all want to eat better. And so making foods that serve those needs is a growing opportunity. One person I spoke with, Nicholas Faraday over at Rabobank, he was a little more skeptical, especially on snack companies, because some of the snack companies have not said so much that they, are going to grow off of GLP-1s, but that they don't expect any real impact. Including Kellanova, which at first was the first company I talked to that was worried, or I shouldn't say worried, that was watching it from a place of interest. That they no longer see it as being something that we have to worry about.
We got to run. Deena, everybody should read it. Go to Bloomberg.com. Deena Shanker, thanks so much. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Okay, Carol, come on.
No.
Charlie, is it too early for
Yes.
holiday shopping?
Yes.
The answer is
Yes.
if you like to plan ahead like I do, yeah, it is way too early.
Okay.
All right, let's get Halloween out of the way.
Oh my God. It's going to be 70 degrees here in New York.
Here's why it might be too early for us to talk about it in the context of if we've done it.
I'm listening.
But it's still important to talk about because it's so important for the U.S. economy, Carol. It gives us a good idea how consumers are feeling right now. Also, there's this port strike in the U.S. Have you heard about this?
We've covered it.
Yeah,
Yes,
no, I'm
thank
just
you very
kidding.
much.
Bloomberg Intelligence says it could drive up costs, slow the flow of holiday merchandise, threaten the ability of retailers to meet holiday demand. Kind of the worst timing for one of these strikes. Well, the management consulting firm PwC has crunched the numbers. They found that even though holiday spending is projected to surge to a record high, the increase this year, Carol, is less than the increase over the previous 2 years.
All right, interesting. So a lot to think about when it comes to holiday spending. Such an important part, as you said, Tim, in terms of the U.S. economy. Ali Furman is consumer markets industry leader over at PwC. She joins us from Seattle. Ali, good to have you here with us. How are you?
I'm great, Carol. How are you?
Doing okay. Trying to assess everything that seems to be coming at us, including that strike on the East Coast ports. We're trying to assess, obviously, the longer it goes on, the more problematic it becomes. How are you watching this from your perch at PwC?
Yeah, that's a really important question and a question of the moment for sure. So look, We are predicting that in-store holiday shopping is going to increase this year. About 45% of the consumers we surveyed over 4,000 consumers, it's our 10th anniversary of doing so, said they want to shop in store. With the port strike, and also importantly, the shorter week, we are losing a week between Thanksgiving and Christmas that we've had in the past. So that actually will shorten the shipping time of gifts that people purchase online. These factors combined, we think, will increase store traffic even more than what our survey respondents had initially planned. And your question when I first joined the broadcast about, is it too early to consider holiday shopping?
Yes.
From our perspective, it seems like it, but really no. Particularly, this port strike issue. Look, most of the goods for the holiday season are already here in the United States. But if you're interested in purchasing an item that's very popular that may fly off the shelf, it would behoove you as a consumer to purchase that sooner rather than later due to some of these issues that I just mentioned.
You guys have a really cool port in Seattle, I must say. Carol and I were there a few months ago, driving past it on the way to that Bloomberg Green event.
Yeah, it's pretty cool, right?
Yeah.
Yeah.
This is pretty cool.
Just a reminder, of all the stuff that goes in and out.
Yeah.
Just take it for granted. But
yeah, when we talk about the West Coast ports, we often talk about Port of LA and Port of Long Beach.
But Seattle,
Oakland,
just blew
San Francisco,
my mind. Yeah.
Seattle, big ones. Hey, talk to us a little bit about some of what you found in the research at PwC that indicates that consumers are feeling a little stretched right now. I was struck by this in the research that we got from you, sent over by our producer, Paul, that the majority of consumers right now are feeling stretched.
Yeah, it's interesting, although not particularly surprising given the inflationary environment. So we are projecting that consumer average spend on the holidays will increase 7% year over year. It will actually take average spend per shopper up to a record amount of almost $1,700 per shopper. But what's interesting about that statistic is for the previous 2 years, we projected double-digit increases in spend. So although we're hitting a record high this year, it is not increasing as much as it has in the previous 2 years. And the reasons why are because 59% of consumers in our survey said inflation will impact their holiday spending this year. And 89% of consumers said price of an item is going to impact their spending. Now, when you compare that to the survey we did 10 years ago, as I mentioned, we've been doing this for 10 years now, only 70% of consumers said that price was an important factor in their holiday spending decision. So, that alone shows you that the inflationary environment is breeding more price sensitive and value oriented customers than the last 2 years, and certainly than the last 10 years.
Allie, two of the other trends that you guys found is that consumers turning to resale items and also the use of debit cards. Walk us through what your findings were.
Yeah, absolutely. This is a really interesting one. So first of all, the broad trend on resale items and consumers, shopping vintage, rental items has been ticking up for the past few years. We do, however, think it's kind of reached a tipping point this year around the holiday season, with 45% of our survey respondents saying that they plan to gift resale or used products in addition to private labeled and store brands. But that's up from 38% just last year. So, when you buy resale items, it's not necessarily more sustainable, but it is more economical. And that speaks to the same point about consumers being more price sensitive and value oriented. So that's particularly interesting. Your other question about payment methods.
I thought this was
is actually
really curious. Me too. Go ahead.
Super interesting. So a couple threads tie together here that I think speak to why we're seeing this kind of shift in preferred payment methods. So our survey respondents this year actually ranked paying with debit card as number one. 65% of folks plan to pay with a debit card.
What about
then
the points?
I know, right?
Come on.
Cash was 58%. Cash was second, and credit card was third. When you compare that to 10 years ago, cash was at the top, and then credit card, then debit card. You tie that stat to the fact that Gen Z So these are the folks who are between the ages of 12 and 27 years old. Their spending power is increasing significantly year over year. I think we're projecting a 37% increase in their spend from last year to this year. This is a generation that probably does not yet have a lot of credit built up. And they're probably using debit cards. They're more likely to use mobile payment options. So that is probably part of what we're seeing there. The other reason we think has to do with the fact that credit card delinquency, has been ticking up slowly for the last 3 years. So there's probably something to that as well, while people are, choosing debit and cash over credit this holiday season.
Ali, you've been doing this at PwC, or PwC has been doing this for 10 years, I should say. So you have good historical data here. But I got to tell you, if somebody were to survey me asking what I'd spend on the holidays this year, I would have no idea what to tell them. Carol, I haven't seen your list yet, so I don't know what you want.
You don't track the kind of family spending around the holidays and stuff?
I mean, in September, in October,
I don't know that I think about it
idea.
ahead of time, but I do at the end.
I do at the end, yeah, absolutely. I look at what happened, but past performance is no indication of what future performance.
That's
so,
true.
Ali, how has the survey done, and how do you adjust for discrepancies that you see when you survey versus when you look back on the data when you actually get it come January?
Yeah, we collaborate with a third party, and we survey a broad range of folks, both generationally and regionally. We do have a set of questions that have been fairly consistent across the 10 years we've been doing it. But of course, we modify questions based on what's happening in the marketplace, what's of most interest at the moment as well. So it's kind of a mixed bag. But I would tell you, from a trend line perspective, there are some pretty interesting 10-year trends. So when you think about overall spending, or actually, let me hit Black Friday. That one's super interesting. So Black Friday is actually up. People plan to shop on Black Friday 3% more than they have in the past year. And it's the highest we've seen of people planning to shop on Black Friday since 2019. But when you compare that to the first time we did a survey, 59% of our respondents say that they were going to shop on Black Friday. And this year, it's much, much less than that. So just the overall behavioral patterns of consumers, the advent of e-commerce coming on strong through COVID and beyond with some of these digitally native generations like Gen Z, is just a really interesting trend line. The other thing I would tell you that's super interesting, so 10 years ago, much higher proportion of people plan to shop in-store versus online. We've seen that over the 10 years we've done the survey steadily decline over the years, as you would suspect with e-commerce coming up and the quote-unquote death of brick and mortar. Well, this year, for the first time since 2018, we see a higher percentage of folks planning to shop in-store. And similarly to the payments point I made earlier, we believe this is being fueled by Gen Z. So it may seem counterintuitive because Gen Z is a digitally native generation.
Yeah, but they like to mix things up.
Yeah, they prefer in-store shopping.
Are you kidding?
They prefer.
What are you? Oh, you're a millennial, right?
I'm like a geriatric millennial. I'm not even close to Gen Z. Gen Z could be my kids.
I always forget Gen Z are your kids.
No, they couldn't really.
Yeah, no, I believe they're toddlers.
Yeah, but thank you.
Or one is a toddler.
Thank you, Carol.
You're welcome. You're welcome.
Sorry, Ali.
Hey, I do wonder, Ali, is there anything, the takeaways that you guys have been doing this for several years, and so you have some nice historical perspective. Anything that out there that says the consumer's getting a little stressed? And just got about 30 seconds.
Yeah, listen, I think the fact that 89% said price is a huge consideration shows stress. I also think that, this K-curve demand where you're seeing people pull back on, some of the wants and the needs, but yet willing to pay for convenience is an interesting phenomena. But but despite that, we broadly feel that the consumer is resilient. We are very much aligned with the philosophy. It will be a soft landing.
Got it.
spend is up. It will hit a record this year despite the macroeconomic climate that we're in. So
Yeah.
So although they're stressed,
Got it.
the advice, shop early. Shop early if you want those
Shop early,
in-demand
shop
products.
often.
Shop early, yeah.
Shop often.
Shh, my husband might be
Exactly.
listening. Hey, Allie, thank you so much. Allie Furman, Consumer Markets Industry Leader at PwC, joining us.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, look at the clock, Carol.
I know. Time flies
It does.
when you're having fun.
We got a lot to talk to Philip Palumbo about because he says that the upcoming election, a softening job market, and slowing consumer spending are all risks that investors should have on their radar.
Just talked about consumer spending, the upcoming retail environment, right?
Yeah. So let's drive to the close. Philip Palumbo is founder, CEO, and chief investment officer at Palumbo Wealth Management. Got about $600 million in assets under management. Phil joining us once again from Great Neck, New York. I want to talk about the consumer because if you weren't listening to our previous segment, we spoke with Allie Furman.
Of course you were
over
listening,
at
right?
PwC.
You listen to us all the time.
Nonstop, Phil. I know. Yeah, he's nodding. He's nodding. He does. What do you make of the consumer right now? Because the consumer is so important to this economy, Philip.
It always is. So a couple of things. In terms of the consumer, right, the key thing is the COVID savings that everybody was talking about now is completely dissipated. And the credit card debt now is up parabolically. And the jobs numbers, except from the ADP report today, are deteriorating a little bit. So the key risk right now really is the consumer and if the consumers continue to strengthen. But I just want to reiterate, and I talked about this in my notes, is that I'm still bullish on the equity market overall. Two main reasons. Number one, the Fed is now accommodative, right? A lot of people are trying to guess 25 basis points, 50 basis points this year, 100, 200 next year. That's really a waste of time. The only thing that we really need to understand is the Fed is being accommodative. And then earnings are anticipated to grow about 9% this year, next year 12 to 13, right? So those are reasons why you want to be positive on the equity market. You just have to watch the consumer.
All right, earnings is a big bucket. So if you divide it into different sector buckets when it comes to earnings, where do you think the outperformance will be? Where do you think the underperformance might be?
Mm-hmm. So I think energy right now and healthcare, if you look at the estimates, it seems to be some negative estimates for this year and next year. And then technology seems to be one of the better growers. And actually consumer discretionary seems to be even above 12, 13% for 2025.
Okay, look at that.
So would you play then on that anticipation? Forgive me, Tim. Would you then, is that how you would allocate in terms of the equity environment? Would you play that earnings card?
The way I look at investing is where are there opportunities, right? So what are areas that have gotten hit over the past couple of years and opportunities where businesses have high returns on invested capital, lots of free cash flow, and somewhat stable earnings. And for me, utilities was that 3, 4, 5 months ago. We took a position in Entergy, which I've talked about on the show with you guys.
Mm-hmm.
Real estate's another area that we positioned clients in over the past 5 and 6 months, which all have been profitable. But today, specifically, the healthcare industry, to me, looks exciting. And the reason why is a couple of things. Number one is we've seen a deterioration in pricing due to COVID. Number one. Number two, regulation due to the IRA Act. And then number three, rates going up. That's all affected the healthcare industry. But there are businesses on the large pharma side of things that do look attractive and also on the biotech side of things. So if you're looking for an entry point, I think healthcare looks really attractive as you think going out to the next 2 to 3 years.
Hey, so on that, Tim and I spent some time talking about the healthcare sector, specifically Humana, which was down almost 24% today. It's still down about 12%. So when it comes to healthcare, again, that's a big bucket. Is that a name that you think with this hit that you would be interested in, or you're a little bit concerned fundamentally about that story?
Yeah, I'd be concerned about that. I'm not going to jump in front of the bus on that one. But what we're interested in is, so we own Johnson & Johnson. And it's something that we're looking to even add to, right? J&J is a company that's been around for a long time, a diverse set of revenues, tons of free cash flow, more than any other business out there at 20% of sales. They're spending a lot of money on research and development, making great acquisitions, especially in the rare disease space and medical devices. They're leaders with their blockbuster drugs and psoriasis, and on the medical device side with orthopedics. So if you think about J&J, where they're positioned today from a fair market value standpoint, Again, it's a boring type business, but I think kind of boring's back right now with the overall market. Everybody's excited about Mag 7, which I'm fine with, but I think the other 493 stocks is we all should be paying attention to, which I think we see move over the next year or two.
Do you feel like the lawsuits over baby powder in terms of J&J, you feel confident enough about them and that overhang?
I do. I feel like the risk reward is there, and I understand what you're saying, and it's definitely still a risk out there. Many analysts are talking about that. But I think, like markets always are ahead of that. And I think markets have priced that into J&J, which is one of the reasons why it's been down from its peak. But overall, again, with their free cash flow, and I mean, we're talking about $20 billion in free cash flow, right? So, and that's every single year. So I think J&J's position, if the lawsuit was to get into a situation where it goes off, it's not on their side at this point, that'd be problematic. But I think overall the risk reward is there.
And so you're saying that a large payout they could deal with?
Absolutely.
Okay. J&J, one of the names on your radar. Can you give us another name?
So on the biotech side, which I talked about with you, is on the biotech side, we use actually a strategic partner that actually gives us names that we invest in a portfolio. We depend on him for that. It's the small cap biotech space. So what I would recommend investors do is take a look at small cap biotech. That's an area that's really been hit hard over the past couple of years, mainly because interest rates were up.
But it's such a risky area. Because those companies are made or broken by approval process of the FDA, whether or not a drug works in a clinical trial. I mean, some of the biggest decliners or gainers on any given day are tiny biotechs that many people have never heard of.
Yeah, so many of these stocks are down 70% from their peak. But again, if you have somebody that's really been in the business for a very long time, understands the industry, understands to know what to look for, especially within management, that's like 50% of it. You can do very, very well, especially it's a sector that really has been beaten up, mainly because of interest rates, and it's a heavy capital cost intensive business. Mm-hmm. So it's an area, you don't put all your money in there, but it's an area where we allocate typically 5% of our clients' portfolios, 2.5%. But it's an area we feel you can make really good money over the next 2 to 3 years.
Yeah, the SPDR S&P Biotech Equity ETF definitely bouncing around since late June, and it's up, I'm just checking here, up about 10% so far this year. Hey, one area I just want to get to before we leave, just got about 45 seconds to a minute left here, Phil, is China. And particularly if you take a look at the NASDAQ Golden Dragon China Index, it's up about 23% for the year. But if you look at just where it's been, I think in the last month or so, we're up about 40%. Are you wading into that area, some of those Chinese names that trade here in the United States? Anything that looks of interest there?
Yes, so we stay away from China simply because we just don't trust the numbers that they put out there publicly when it comes to their companies. We think it's an area you could probably make money because of the stimulus that they put through, but overall, as investors, we shy away from there.
All right, going to leave it there. Fun to talk names and some areas with you. Phil, thank you so much. Philip Palumbo, he's founder, CEO, and chief investment officer at Palumbo Wealth Management. They've got roughly $600 million in assets under management. Phil joining us from Great Neck, New York.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.